If I'm going to have to guess, and this is a standalone company in 5 years, WBA is probably anywhere from $75 a share to $125 a share, somewhere in there in 5 years from now. So yeah, WBA, I think it's an easy money stock, and that's why I put seven figures in the stock.
Don't you just love Jeremy Lefebvre? Welcome back to Strongman Personal Finance. It is my humble opinion that Walgreens Boots Alliance is cooked. And in the long run, they will declare bankruptcy, much like Rite Aid did. So let's go ahead and talk about what's going on with Walgreens, because the stock over the past 5 years is down 83%. And a lot of you are coming in and you're looking at this juicy dividend yield of $1 per share trailing, or a 10.8% yield. And you're seeing that the price has gone down a lot. And you're thinking, well, it's cheap because the price went down, and I can collect passive income and get a 10% return. Number one, that's false, because your return is your total return, which is share price movement plus the dividend. And second of all, dividends can be cut. They can be cut. And when you look at a dividend yield, you're looking at a trailing dividend yield. So what are some of the financial metrics that are really hampering Walgreens? Well, their revenue over time has grown. Okay, it looks like it's underperformed inflation over the past 5 years. If you look at their revenue in the third quarter of 2019, their revenue was $29 billion, and it's since grown to $37 billion, which looks like growth, right? Well, that's actually not true, because when you adjust it for inflation, I bet you it's probably lagged inflation. So your total revenue growth as an owner of this company has been flat over the last 5 years. The biggest problem, however, is you can still grow profits over time, right? Like, your revenue can be flat, but if your business becomes more efficient or doesn't have pressures, you can still grow earnings per share, free cash flow per share. Unfortunately for Walgreens, their gross margins are contracting, okay, because they have pressure with their reimbursements from insurers. That's cutting massively into their margins, not to mention theft, et cetera, et cetera. Their gross margin, which is their profit at the top of the income statement, has trended downwards over time because of all the reasons I just stated, and because of competition, which we're going to look at in a second. So their gross margin has gone down, and that trickles down to the bottom of the income statement. Their operating margin has also contracted precipitously. This is their profit before interest and taxes. Their operating margin is barely 1% in the most recent quarter. But over the last couple of quarters, we can clearly see that they've had negative profit from their operations. And their bottom line profit margin has also dropped precipitously. It is now negative. They are recording a bunch of impairment charges, which we'll talk about in a second. Free cash flow margin. This is your profit, operating cash flow minus free cash flow, or minus capital expenditures, has also contracted. You see flat revenues on an inflation-adjusted basis, and you see margin compression, which is, in my opinion, the worst part about this company. That's eventually going to sink it because it's never been a high-margin business. Now, there's a couple things wrong with Walgreens. Number one, they got in trouble for fueling the opioid epidemic. We can clearly see, if you just type in Walgreens opioid settlement, they're shelling out millions and millions and billions of dollars because a lot of states have sued them for fueling the opioid epidemic and causing widespread harm and damaging people's lives because they just want to churn out as many prescriptions as possible without worrying about the long-term effects on people. And I would say they're guilty because it looks like they've been found guilty and they are paying huge settlements, okay? This is a hurt to their margins, and this is a risk to the future because they could be incentivized in the future to also sell other drugs that could potentially be harmful because that's how they make money, okay? Another massive competitive pressure, and this is recent news. 1 day ago, Walmart, the best company in the world, joined same-day pharmacy delivery race. Will this help pharmacy deserts? Walmart is moving in, as well as Amazon, on prescription delivery. Why would you want to go to a pharmacy? I feel like only old people go to a pharmacy. You walk into a pharmacy or you drive around in the pickup, and guess what? You got a bunch of overpriced junk in the front that you could get way cheaper at Walmart. And now Walmart is doing delivery. Delivery is going to absolutely, in the long run, eat the lunch of pharmacies. Why even go to the pharmacy at all? I hate going to the pharmacy. It's a pain. I'd rather have my prescription just dropped off in the front of my house. This is a huge problem for Walgreens that I believe will send the company under. Now, let's look at the most recent financial report, and we're going to see some interesting things here. So the first thing we see is the loss per share in the current quarter. This was reported October 15, 2024. Includes a non-cash charge for valuation allowance on a deferred tax asset primarily related to opioid liabilities recognized in prior periods. A deferred tax asset is simply taxes you think you're going to save in the future because of temporary differences between accounting for book value, accounting for books, and accounting for taxes. You recognize a deferred tax asset when you believe it's likely that you're going to save taxes in the future. However, when that gets reversed, that actually hits against the income statement because you have to accrue a valuation allowance, which is a credit, against your deferred tax asset to bring the balance down, and the debit is an expense, which hits your profit and loss, okay? That's one thing. That can fluctuate depending on changes in tax law and other factors. The big one is non-cash impairment charges for CareCentric's goodwill and equity investment in China. Non-cash impairment charges are non-cash charges, but they tell you something about the future. You impair something on your balance sheet when you believe it's not going to generate sufficient cash flows to justify its balance on the balance sheet. It's a signal to the investor that they're not going to make as much money from their investments as they originally thought. That's not good. On top of that, they have net reimbursement pressure. So their reimbursements from insurers, et cetera, are going down. What does that do? That hurts their margins. They have massive competition, mail-in freaking prescriptions, and reimbursement amounts for prescriptions have gone down. And I expect the government and other organizations to be even tighter with reimbursements going into the future. The only bright spot is that their revenue increased faster than inflation at 6%. But overall, over the past 5 years, I doubt their revenue has surpassed inflation, okay, their growth in their revenue. On top of that, they're recording non-cash impairment charges related to VillageMD. VillageMD is, there was an acquisition they made, and basically they were trying to put doctors and, a clinic basically inside the Walgreens. So you could go to the clinic and then you could walk across and get your prescription. I've never seen one personally, but that's what they try to invest in, okay? They've impaired that as well. That investment has not done well. So they've had a series of bad investments, okay? On top of that, they have challenging U.S. retail environment, theft, overpriced products. Basically, Walmart's better for everything. Net reimbursement pressure, which we talked about. Lower sale leaseback gains. A leaseback is when you have a property, you want to generate cash, so you sell the property, but you immediately lease it. So what happens is sometimes you generally record a gain, and you get rid of the capital asset on your balance sheet, and you replace basically depreciation expense with rent expense. You're renting a property that you originally owned, but you sold it. They're getting lower gains on leasebacks, okay? And then lapping the reversal of incentive accruals. So there's a bunch of different things that are attacking Walgreens' profit margins overall. And the fact is they run a store. Like, it's an in-place store. How is that going to compete against delivery? It's more convenient to get delivery. And who goes to Walgreens to buy stuff besides picking up their prescriptions? I really want to know. I'm serious. It's overpriced. It's that simple. Why go there when you can go to Walmart or Food Lion or something else if you live in Virginia and whatever? So let's go ahead and look in a little bit more. So they give their fiscal year 2025 outlook. So they're projecting, it looks like probably a little bit of sales growth. But here's a red flag. They're talking about adjusted operating income and adjusted EPS. Whenever you see adjusted, automatically think clown earnings. Adjusted is just made up accounting. They add back stuff to make themselves look more profitable. Adjusted is garbage. You need to look at the totality of the company's earnings according to GAAP, generally accepted accounting principles, because a lot of times you'll see one-time charges that, they're one time, but they're actually there for a reason. They're there for a reason. They're indicating something to you. Be very careful when you start seeing adjusted. That generally means it's an unprofitable business or there's problems going on overall. Okay? Now, if we go look at the financial statements in general, okay, they have total current assets. This is cash, marketable securities, accounts receivable, inventories of $18 billion. It looks like they roughly have about $8 billion of very liquid capital. That's cash, marketable securities, and accounts receivable. Inventory is a little bit harder to churn over. I mean, you can sell it pretty quickly, but very liquid capital is generally cash, marketable securities, and accounts receivable. So they roughly have, what, $8 billion there? And their current debts are $26 billion, mostly in trade accounts payable. So they're running it's very illiquid. Okay, they have a lot of current debts coming due in the next year, and they really don't have a lot of cash, marketable securities, and accounts receivable. Okay, now they've been selling some of their other investments. Like I think they have an investment in Sensora. They've been selling that to generate cash. They've been doing leasebacks to generate cash. But that's a sign of a declining business. They're trying to sell stores because they're trying to generate as much cash as possible to keep themselves going. Okay? That should be very concerning. They also have $15 billion of goodwill. Goodwill is when you buy another business more than the fair value of its net assets. Happens a lot because you're going to pay more than the value of an assets are worth for a business, theoretically, because that business will generate future cash flows. However, look at the change in goodwill from $28 billion all the way down to $15 billion. Okay, that is huge charges. That tells you they made crappy investments. That's exactly what that tells you. And if those investments continue to deteriorate, and it's based on judgment, guess what? That goodwill can be impaired any or even more. Their total equity is less than their goodwill. Their total net value of the business is less than their goodwill. They are underwater when it comes to debt versus assets, if you exclude that goodwill. That's not good. And if you count intangible assets as well, guess what? It's even worse. They are not in a good financial position, okay? This is very, very bad. Now, they're still generating positive operating cash flow. This is for the 12 months ended August 31st, 2024. So, over the 12-month period, their operating cash flow declined to about $1 billion. $1 billion versus $2.2 billion in the prior year. That's not good, okay? They have had their operating cash flow collapse 50%. And when you factor in free cash flow, you take out additions to property, plant, and equipment, it's negative, okay? They're selling their stores and they're renting them because they need cash desperately. It's not good. Very, very bad. And on top of that, it looks like they're cutting their dividend. You see that? Their dividend has gone down. Yeah, when you see the dividend yield, that's a trailing metric. It means nothing about the future. So overall, I think Walgreens is in big trouble. And I would not be surprised if they go bankrupt. So I'm very glad that Jeremy put $1 million into this because he's a fraud, and I'm glad that he lost a lot of money. Let me know your thoughts in the comments below. Don't forget to hit like and subscribe. And if you want personalized services, like me doing your taxes, I'm a CPA, like me doing sponsored videos, I'll cover whatever topic you want. Or if you want to talk to me one-on-one, see the pinned comment below. Have a wonderful weekend.